Welcome to Motley Fool Conversations. I'm your host, Rich Lamello. Today, I'm incredibly honored to be joined by professor and author Bruce Greenwald. He's a legendary professor at Columbia Business School, a leading authority on value investing, and the author of several groundbreaking books, including Value Investing, From Graham to Buffett and Beyond, Competition Demystified, and The Curse of the Mogul. Over the years, he shaped the thinking of some of the most successful investors in the world, and today he's here to share his insights with us. Professor Greenwald, thank you so much for being here, and welcome to the Motley Fool.
It's always a pleasure to deal with the Motley Fool.
That's awesome. Well, and for the listener, I just told Professor Greenwald that back in the mid '90s, I was one of his students in his value investing class. So he had a huge impact on me. Professor Greenwald, you have been called the guru to the gurus on Wall Street. How do you feel about that title?
Okay, so first of all, that title was in the New York Times.
Yep.
And being in the New York Times, I would not be inclined to believe it. And I don't think you should be either.
Okay, enough said. What drew you? What kind of first drew you to the world of investing and economics?
Oh, I'd always done that in life. I mean, I think the real revelation for me was that having come from Harvard Business School,
Mm-hmm.
where we taught an enormously successful course where we taught people to evaluate investing opportunities, whether within companies or in financial markets, using discounted cash flows. And was heard sort of Mario Gabelli bring Roger Murray on at the Museum of History. And it really was. I mean, it was like preserving a dead language. And it was immediately clear that the course that had been so successful was a real piece of crap. And that the value approach was just much better.
Sure.
And I think that's the revelation, and I think is the starting point for any investor at this point, which is that markets are not efficient in the academic sense, but there's just an inescapable sense in which markets are efficient. And that is that, the average return to all investors, asset class by asset class and overall asset classes, therefore, has to be the average return to all assets. Because everybody owns everything, and the derivatives of various sorts net out. There's a buyer and a seller. So if you're going to be above average, somebody else has got to be below average.
Sure.
And it is that imperative to be above average that investing is really all about. And in life, that's a pretty good imperative to operate on the basis of. And I think what I learned from the value tradition is that there are three elements of that in investing if you're going to be a good investor. The first is you've got to look intelligently for opportunities. You're not going to look at everything. And, historically, the way Benjamin Graham thought about that was stay away from the lottery ticket glamour stocks and concentrate on the ugly, boring, out of fashion, but cheap stocks. And that's not a stupid thing to do in that level of market, but I think that has changed, both as you guys at Motley Fool and other people in the value community have done a good job. And I think, as we'll talk about, you're going to have to do better than that in the future. The second thing that, I think Warren Buffett, when he talks about it, slights Ben Graham's insight is that he really concentrates when you read him, rather, on the difference between speculation and investing. And the way I think to say that is you have to know what you're buying. And when you did a DCF, you had no idea what you're buying, because what you're doing is you're taking very good information, which is your estimate of the near-term cash flows, and very bad information, which is the distant cash flows, and you add them together. And the distant cash flows are in the terminal value that dominates. You add bad information to good information, you just get bad information. And that is not the way to go through life. I mean, in Animal House, fat, drunk, and stupid is not a good way to go through life. And in investing, DCF investing is not, in most cases, a good way to go through life. So you have to know what you're buying. And you have to have a really good discipline to do that. And the third thing is really, and this is about Mr. Market, you've got to wait for your price. You have to be patient and you have to be disciplined. And it is those three things that I think finally, after sort of doing many exciting, stupid things in my youth, taught me to and teach about it, but actually to do it, to concentrate on those. But I think, and this is the other thing I learned over time, which is why I didn't do a particularly good job of teaching you, you've got to be adaptable. The world changes. And in particular, if you look at the period from 1960 to 90, which is the great era for the traditional value investors, you look at Buffett's performance in that era, it's phenomenal. The economic environment is one in which globalization and greater sophistication among investors and managements is leading to intensified competition. And it gets harder and harder. I mean, there are big global markets. Competition is more intense in those big markets. Margins shrink. It's harder to find things. You can't just sort of buy IBM or the Nifty 50 because you're dealing with more sophisticated investors over time. So, what worked in those days, which is hard values, asset values, earnings power value, things that you really could reliably measure. And don't pay for growth because it's very hard to tell the value of the growth, which is in that terminal value, worked really well.
Mm-hmm.
What's happened since then is the world has really changed. From 1990 to today, both through services and changes in the nature of technology, we've gone from big global markets to local markets, both in geography and services, where services are locally produced and consumed, and in technology, where you look at the companies, they're all specialized. Oracle does only databases. Google does only search. Facebook, or Meta, if you want to call it that, does certain kinds of networks. Linux does other kinds of networks. And it's just small markets. The thing about small markets and also continuous interaction between producers and consumers is that you have to have a big market share to be stable. So, global automobiles, you can survive on 2% global market share. If you're doing cell phones on a national basis and you don't get 15% market share, you're not going to be economically viable. If you're distributing, heavy caffeinated soft drinks, you need 25% share to do that efficiently.
Yeah.
Second thing is that to get to that share, there's a big issue of how fast you can do it, and that's all about customer captivity, which is much higher in those environments. I mean, you have a not necessarily happy, but an inescapable and continuous relationship with Microsoft, with Oracle, and so on, just as you do with your local doctors, your local stores, your local housing markets, and so on. So
Sure.
You've got higher customer captivity, higher minimum efficient scale, and there's a really simple formula for measuring moats, which is that if I've got to get to 15% and 0.5% share changes hands a year, it's going to take 30 years to get there. That's a big moat. If we're talking about caffeinated soft drinks getting to 25% at 0.5%, 0.2% a year, it's a 125-year moat. Automobiles, 2% at 1.5% a year is no moat at all. The world is a moated world increasingly, and unfortunately, that means growth matters. So that when we talk about those three things, what does it take to be or to look intelligently for opportunities rather where you can be on the right side of the trade? And the answer now is you have to be specialized. Being able to measure future growth and how well managements understand that growth means you have to have serious industry knowledge. And a classic example of that is what happened to value investors. I don't know if you remember when Jim Grant decided that Deere was the short of the century. And this was in the late 90s, well, actually the late 2000s. And that because the market had been juiced by the government, that was going to stop, you were going to be in trouble. What had happened is Deere went from a global manufacturer to a local service company. What it did was, in the precision agriculture world, was it had local software that drove smart seeders that put every seed in the ground at exactly the right depth, at exactly the right time of year, with exactly the right amount of fertilizer and pesticide. And those smart seeders could do 140 acres an hour with nobody in them because they operated off GPS systems. but the software was local. If those machines broke and you didn't have a local service support organization, they were going to be worthless. They were so expensive because, 4 people now ran family farms of 12,000 acres, which is 20 square miles, more or less. You were going to be in real trouble, and they were expensive. And so you did financing. And we know that if you're going to lend money, you have to have good local knowledge of the creditworthiness of those local borrowers. And then because they made them out of plastic, they were big secondhand markets because they didn't rust out. And those are local. Nobody ships secondhand equipment all over the world. So you would commandeer from a big global competitor in making tractors and so on to this local precision agriculture company. And you see it in the margins. But most importantly, you could see it, which go typically from 8% in good times to 25% in good times because they're big moats. They completely dominate each of these local markets. And in bad times, when they used to go to loss making, all of a sudden they go from 25 to 15% margins. The world has changed. And as you recommended the short, and a lot of people, he's a smart guy. It's a persuasive argument. A lot of people, shorted it at 90. It did go down to 75, but today it's at 450.
Yeah.
And so having to understand industry structure like that is the first step that you have to do. And that means if you're going to be an intelligent searcher for opportunities, you're going to have to be a specialist.
Yeah.
So that's actually changed as the world has changed in this direction. Second thing is that, if you're going to put a value on the distant future because growth matters, you've got to adapt what you do. You're not going to be able to just do asset value, earnings power. I'm not going to pay for growth because you're going to be left with the terrible opportunities. And especially the asset value concentrators just have been murdered over the last 20 years. What you, I think, have to do, and that's why I did such a bad job teaching you, is that you're
Not true.
You're not going to be able to do a value. You've got to ask the question, if I buy at this price today, what sort of return am I looking at? And that's going to consist of a cash return, which is just, earnings power divided by the distribution policy or multiplied by the distribution policy. Reinvestment returns, what do they do with the retained earnings and how good are they at understanding these competitive dynamics and the strength of their moat, and are they going where other people are, have the strong competitive advantages? Then you've got organic growth, which now in this circumstances produces value because you're earning above the cost of capital on those investments. And then the fourth thing you have to look at that almost nobody did, when I was teaching you, is fade. Franchises go away, and you see it with countries like Intel. When the market gets really big and the product gets commoditized because it's not so special anymore, you can't keep, the small competitors like AMD out. You can't keep them down.
And
So,
when you talk about the cash returns, are you talking about like dividend and
dividend and
yield
buyback.
buyback? Yeah, okay.
So, I'll give you an example. Suppose
Sure.
you think the earnings power of this stock is $8 a share.
Mhm.
Look at the history. And again, you've got to understand management and their imperatives. But if it looks like they've been distributing 80% of the earnings in buybacks or dividends, you don't really necessarily care which, because you can always, sell into the buyback in proportion to the total holding if you don't like what they're doing, or not if you think they're if you think they're underpaying. That if it's an 80% distribution on an $8 earnings, that's $6.40. Divide that by the market price, that's a cash return that you're getting. And you ought to expect to get, if you're a good judge for this company in this industry, of those trends. Then you've got, if they're distributing $6, 80%, $6.40, they're reinvesting $1.60. How well are they doing that?
Right.
Is that going to, and you have an idea, the first thing you want them to do is every day in every way improve their operating structure, doing the boring, simple cost cutting that goes on, which typically doesn't consume a lot of capital. And you want to check for that and trends in that for this industry. And then in the case of Deere, to go back to it, You don't want them to go after Kubota, which is the great specialist in wet agriculture. You want them to do one territory at a time in, the Americas and Europe to the extent that they can do it. So you want an intelligent expansion strategy that is consuming those retained earnings intelligently. And if they earn 20% and they reinvest $1.60, their cost of capital is 10. They're creating $2 in value for every dollar they reinvest. That's another 320.
Yeah.
If they're earning 5% with that 10% cost of capital, they're pissing away half of it. So the 160 is worth 80 cents. But you've got to be able to do that calculation. So you've got a cash return, a reinvestment return, and then organic growth minus the minimal investment you usually have to put into that. And then you've got to say, okay, I know this franchise is not going to be here 200 years from now, but what's a reasonable lifetime for this? And then you just use the rule of 72. If you think this is a 30-year safe franchise, it's fading at 2.4% a year. And those numbers are significant. So you've got the cash return, earnings, reinvestment return, the organic growth minus the fade.
And the organic growth, you're calculating that as revenue growth, but also margin expansion, right?
Yes,
like at the
and it's
operating
industry-wide. It's not just what you're doing.
Right.
So it'll be history for the company, but supplemented by your judgment of how much of that is just driven by demand and, the overall product and technology improvement. That's exactly it.
Yeah.
So that's a whole area where I don't think people are used to doing returns. And if you listen to really intelligent people like Seth Klarman, and I think he did say this to you, he said increasingly he thinks it's more important for him to calculate returns than to calculate values, which are much harder to calculate, especially in this growth world.
Yeah.
So you've got to adapt how you manage to know what you're buying. Now, if you're doing event-based investing, where there are near-term payoffs that are pretty well defined, go ahead and use a DCF, because that's exactly, if you're doing competitive market investing, asset value, earnings power value is the way to go. But you've got to have a Catholic approach, that is a broad approach to how you're going to value these things based on your understanding of industry structure. And fortunately, the last part of this hasn't changed. You still got to be patient.
Yeah. Yeah. And I'm curious, because probably the most difficult to, kind of everything else is the numbers, but the fade rate, that's an interesting, kind of dynamic, like how to calculate that.
That's why you really have to have industry knowledge. If you've thought about that intelligently, and the other side of the trade hasn't. So one of the things that kills people is market growth. So let's do the company that really this happened to. And actually, I had a big fight with the editors of the second edition of the book where they said you can't in 2018 say Intel is going down the tubes. But if you looked at the fact that that market was growing, that the incremental value of their improved technology was being less and less salient and noticeable, those barriers to entry were falling.
Yeah.
Because, the fixed cost of having to bring out new chips every 18 months to 24 months, which AMD couldn't keep up with, no longer gave Intel a sustainable advantage. And then you look back at the histories of peripheral makers and other people in that kind of tech industry making products, and you see that happens, and it's about a 30 to 40 year cycle. And they now they were originally a memory company, and they'd seen it happen in memories, but they by 2018 had a good 24-year run. So there was a lot of time left. And at 16 years, 16 years into 72 is a 4% fade rate. That's a big subtraction from your return.
Estimated returns, yeah.
Yeah.
And do you think that value investing as, kind of defined today, can that be applied outside of public markets, like in private equity or venture capital?
Would hope that every management does a value calculation when they do their capital budget.
Sure.
And mostly they don't. I mean, the biggest, I think of the things we've talked about measuring for these franchise companies, where the biggest gain from understanding is going to come from is going to be from understanding management imperatives. Because if they, I mean, and this happened, I mean, so I did a Deere case because it's so compelling.
Mm.
Deere was very focused on one incremental market at a time, just taking successive bites of areas that were adjacent to their existing service infrastructure, where they knew how to do the software for that and so on. Kubota, which had dominated wet agriculture and had higher returns. If you look at they're a conglomerate, but if you look at their agricultural equipment, they were actually higher than Deere historically, which is rare for a Japanese company. They decided they were going to go after Deere, and if you look, say from sort of 2018 to today, Deere, as I say, has gone from 75 to like 450. Kubota's been absolutely flat.
Mm.
And so that management that doesn't understand what returns they're going to earn in those non-competitive environments or where they're at a competitive disadvantage is devastating. So no, I think this is across the board.
Yeah.
And you better understand the degree to which your management understands what they're supposed to be doing and where the value is here. No, value investing, as I say, we thought we were teaching people with DCF calculations to do intelligent investing within companies. And the reality was that we were not. That their understanding of the competitive structure, the structure of competitive advantage, the implications of the duration of that structure, what they were going to get from organic growth from those investments, and what they could do with the reinvested money in terms of generating cash. And then intelligently deploying it between reinvesting it further and handing out to the shareholders turned out to be crucial. And we did not have a structure for doing that calculation intelligently. And we thought we were the cat's meow. Harvard disease.
And just to shift gears a bit, but to kind of stick with your work, in Competition Demystified, you argue that barriers to entry are like the most important element for a competitive advantage. Can you kind of elaborate on that? And is that
that's what we just went through? I mean,
yeah.
Now barriers to entry, I think I've learned since I taught you, really are much more easy to calculate than you think. I think this is one of the great obscurities that Warren Buffett has managed to use to protect his own franchise. It is literally, what is the minimum sustainable share I need in this market to earn my cost of capital, divided by the share stability. And, if you did it for autos, it's like, 2 divided by 1.5, which is sort of a year and a half.
Right.
You do it for cell phones, you got to get to 15%, 0.5% changes a year. It's a 30-year moat. If you do it for caffeinated soft drinks, it's sort of 20 to 25 at 0.2% a year, because that's the measured share stability that you see. That's 5 times 20% is a 100-year moat. Or if you think it's 25%, you have to get to it's a 125-year moat. That's a simple calculation. And when you look at your 3 varieties of competitive advantage, economies of scale, that clearly fits into the minimum sustainable scale a competitor has to get to. Customer captivity and also technological advantages are what generate share stability. So all those varieties of competitive advantage you can quantify in the end by the width of that moat. So Warren Buffett has always talked about, moats are critical, but he's never revealed how easy that calculation is to do and how powerful, I think, because I spent my life trying to betray all his secrets, that looking at the moat approach is.
Okay. And how, for an investor, because obviously Motley Fool, we cater to individual investors. How does an investor, sitting at home with, kind of the resources available to them, assess management quality objectively?
Okay.
What's the best way?
That is, I think, the really great question here. And you can't do it in a disciplined way and become a specialist one industry at a time. And if you look at Buffett again, to come back to the great investor, he basically had 4 industries where he did much better than everything else. and they were consumer non-durables, Coca-Cola, See's Candy, old media, insurance, and actually banking, because he'd owned the Rockford Trust and he really understood those. And you look at his performance in those areas, they're phenomenal. When he tries to do precision cast parts and doesn't recognize that the industry is going to composites and they're a metallurgical company and you're going to get a really high fade rate, he has to write down more than half the value, or at least half the value of his investment. So being a specialist, even for somebody as smart as Warren Buffett or I think Seth Klarman, is really important. So that's where if you are at home and you're really attracted to investments, you have to do one industry to start with, and you probably want to do it with a couple of friends who you trust their intelligence and their application. And when you master that industry, all these things that you have to be able to assess, like management and so on, I think will become clear.
Okay.
How disciplined are they about their first priority being every day in every way cutting costs? How disciplined are they in their expansion strategy of pursuing markets where they have competitive advantage, adding groceries for Walmart, and then expanding at the margins where their infrastructure carries over? Third is, how intelligent are they about not investing money they don't need and giving it back to you in some form? And the fourth thing is, how good are they at human resource management? Do they hire a lot of people in good times and then get rid of them in recessions, or are they stable? And do they have a real succession plan?
Plan for the management, yeah.
And I think understanding those and how to do it well is what people should do. And if you're not willing to specialize and start with one industry and maybe stop with 3 at most, you should be buying index funds.
Okay. And as far as you touched on it earlier, some of these, kind of large tech companies, Amazon, Google, names like that, do those types of platforms that are, kind of singularly focused, do they represent the ultimate barrier to entry, or are they more vulnerable than they appear?
No, again, if you dominate a small market, a specialized market like search, and also, by the way, because they customize these things. Google, until they started with the stupid AI, used to really customize your search experience. So they had one-person markets. Well, you could dominate those and they're really hard to displace. If you look at Oracle, they really went into companies and they managed their databases, one company at a time. High captivity, high, fixed costs of getting in there. So if they have those strategies of small specialized markets and continuous interaction to generate customer captivity and continuous improvement, so that people coming into the market have to spend a lot to develop the product on a continuous basis, which is a fixed cost, which also raises the minimum share you have to get in a particular market, they're going to do well. So
Yeah.
it's understanding those economic imperatives that are really important.
Okay. And obviously, a lot of talk over the past 6 months or so about tariffs, a lot of talk about the Fed and will they cut, a lot of talk about Fed independence. How do you account for lack of a better phrase, regulatory risk when assessing industry's future?
The irony of the economics discussion is it's completely off point. The regulatory risks, and if you can see this by administration, is not what everybody thinks about recessions, tariffs, and so on. It's interfering with management. So if you correlate number of pages in the Federal Register, which is the continuous new regulation, with private productivity, it is uniformly negative. And you can see it. If you look at the first 3 years of Clinton, when he's regulating like crazy, productivity growth is 0. They get slaughtered in the midterms in 1994. They get religion. They stop interfering. The year of big government is dead, he announces. Productivity growth goes to about 3.5%. Obama, coming out of the financial crisis, doesn't regulate. Productivity growth is like 1.8, 1.9. Second term, he decides he's going to use his phone and his pen. Productivity growth falls to under 1%, 1% or so. You see it with Bush. He's good in the first term. He decides he's going to help the economy by regulating. In the second term, on a continuous basis, you see the pages in the Federal Register go through the roof. Productivity growth falls dramatically. That is the big threat. And under Trump, in that sense, you're much better off than you were under Biden because it's a much less lower emphasis on continuous regulatory interference. And productivity growth is ultimately what is going to drive this high productivity. These high levels of profitability. If you look at monetary policy, every year I do a forecast of GDP. I never look at monetary policy. All the evidence is, and you look at the Fed's own projections of what's going to happen, and they say, oh, we're going from 2% growth to 3% growth to 4% growth. Next year, it's 2% growth. Then they say, okay, we're going 2, 3, 4. Next year, it's 2. I think all the evidence is, and this is going back to the 1970s when I was in graduate school. Nobody could find a consistent interest rate effect. They found cost of capital effects. If you did an investment tax credit that was time limited, you could shift investment because the cost of capital of investing now and getting the credit versus the future went down. But consistent interest rate effects, nowhere in the world could people find them.
Okay.
If you look at monetary policy, and basically it's the reserve requirement time, and the amount of reserves interacting. If you looked at the 1960s, you can see how powerful it was, because basically in those days when you didn't pay interest on demand deposits were a kind of super equity. They cost the banks nothing. They didn't have to pay dividends on them, and they could absorb a lot of risk. The equity that came from a monetary expansion was huge. Right. Once they removed that interest rate cap on deposits, that effect went away. So you look at the Alan Greenspan years, he's moving things all over the place. You go from plus 14% in the money supply growth to minus 6%, which is unprecedented. And nominal GDP just grows in a straight line, has no impact. And I think that's been true since then, if you look at the Fed's forecast. So I think for the real economy, talking about the forecast is misplaced. On the other hand, for the markets, matters a lot.
Sure, yeah.
That's what's going to give you your, you're going to compare your return against is that cost of capital. So right. It does matter for markets, but for the real economy, as I say, it's the regulatory intensity that seems to matter. And there are these other underlying changes in the economy. So all over the world, you have huge productivity growth problems. I don't know if you look at 1960 to 1990, Japanese productivity growth grew 5.5% a year. You look at post-1990, it's 0.9% a year. You look at Europe, France, Italy, Germany, they were 3.5% from 60 to 90. Post-1990, they're as bad as Japan, 0.9%. And you're seeing this in the dissatisfaction and difficulty. USA, Canada, UK were 2.5% from 60 to 90. We're still at sort of 1.5%, especially if you don't aggressively regulate. The Canadians are down around 1.2 or below that, and the British are about 0.5 to 1%. And, they're not going to grow without productivity growth unless they want to let a lot of people into the country. So I think the focus of attention to economic policy in the light of this 30-year difficulty. Now, the other thing that's gone on, as I say, is that we've gone to small markets, both in product space with specialized technology and in geography with the move to services. Profit share of U.S. national income in the 90s from 89, you average over the cycle from 89 to 91, was 8.5% of U.S. national income. What do you think it is the last few years? It's somewhere between 15.5 and 16.
Wow.
So the markets are doing really well, but it's these structural changes in the economy, not the sort of typical misguided macro discussion. And the effects of these things vary by industry. That's why, really, if you want to be an investor, you better be an industry specialist, because there are
Yeah.
a lot of things going on that's very misguided, which is why I'm going to ask you to do, as really probably I think, the best investment advice service out there, to do one thing that I don't know you do, although I don't know what happened. I know you were talking about doing funds at the Fool in the 90s, but I don't think that happened to any great extent. But if you would just have a scoreboard for the advice that people give, the stocks they recommended, the dates on which they did it, and what happened over the next 3 years, and you did it for yourself, I think you would help people out a lot in identifying good advice and bad advice. And I suspect that you yourselves would look really good.
Sure. So accountability on the calls. Yeah. And,
but just regularly, I mean, there would be a scoreboard box.
Sure.
You
Sure.
have Ray Dalio and all the rest of the macro idiots in there. Hope you edit that out.
Well, and kind of on the back of that last question, and I fully hear what you're saying, but how should investors look at, again, thinking from the perspective of individual investors, how should they navigate geopolitical risks? Strip out economic issues, tariffs and things like that, but the geopolitical side of things.
Well, okay. So again, what's happened when you go to services or decentralized technology is that you're dealing with smaller production units.
Mm-hmm.
So when you had a manufacturing plant, there was a Carney telephone company plant that in 1947 had more than 50,000 workers. You got much smaller service units, and it's harder to put managers and scientists, that is engineers, to work in that environment because the scale of the production units is just not large enough. So you need companies that are good at that and countries that are good at making up for that. So the Agricultural Extension Service in the United States, which dealt with agriculture, is a phenomenal institution. Look at countries that do that well in your industries. And again, becoming an industry specialist, where this difficulty that has led to this huge drop in productivity growth is one that they're navigating reasonably well. I mean, you look at U.S. productivity growth from 60 to 90, we're the bottom. You look at it since 1990, we're at the top. We're not doing, I think, as well as we could, but it's a huge change. And I think it's understanding that phenomenon. Small markets are your friend. Continuous customer and, business interaction is your friend. So look at how those are developing. It's probably going to do more than the geopolitical risks out there, which are mostly going to affect the cost of capital. And in the long run, that tends to stabilize. So it's this long run future, taking advantage of this huge increase in the spread of moats out there, which has led to this huge increase in profitability. And that's very unevenly distributed across countries. Now, inequality is also inevitable. I mean, in service businesses, increasingly people work individually. In manufacturing plants, they work collectively. You work collectively, you get the average wage. You work individually, you get what you do. And if you think those trends matter, you ought to think about how that structure is being handled. And by the way, if you want constructive government intervention, you want people who worry about the bottom end of the income distribution, making sure that everybody has a decent standard of living and can then sort of organize a life that's rewarding for them. They're worrying about the upper end. We've seen that in Venezuela. We've seen that in Zimbabwe. We've seen that in North Korea. We've seen that increasingly in China. I mean, that's a disaster. I mean, China is, again, something that's really fallen off a cliff. I mean, they lie about everything. But when you have people who lie about everything, you need a reliable counterparty. And that's the trade data. So that, the IMF, if China reports 500 million in exports to Germany, checks that Germany reports 500 million in imports from China. And if you look at the trade data, the growth of China in the last, since say 2012, which is the data that I've looked at, is under 2%. And trade typically grows faster than the economy. Now, they're still a poor country, but they're not growing at 5%.
Right.
They're probably growing someplace around 3 at best. And there's no stupider sort of discourse in the press than China announces they're going to make 5%. And they say, oh, that's such a difficult target. I wonder if they're going to make it. And guess what? They always make it. Because when the local parties report, they report
5%. Magic.
So, you have to, again, that's why I think specialization is so important, that even in assessing geopolitical risk, it's going to be industry by industry, country by country.
Yeah. Any industries stand out to you right now as looking particularly compelling?
I think, look, small service businesses that are going to benefit from AI. And here's the other thing about AI in general. And it's funny that in 1963, when I arrived at MIT, I actually took a course from a guy called Marvin Minsky, who is the great father of AI. And he said the most intelligent thing then that I think still applies, which is artificial intelligence is exactly like human intelligence. It's specialized. You're not going to have AI doctors who do general surgery and also prescribe medicines. You're going to have orthopedic surgeons. You're going to have thoracic surgeons. You're going to have all sorts of specialists. Same with lawyers. Same with professors. They don't do all subjects. So again, you want to look at industries that is using AI intelligently in their particular bailiwick.
Sure. Okay. And if I guess if you could leave the audience with just one piece of advice for a lifetime of investing. Obviously, you've written many books, kind of about investing and corporates, corporate America. But what would that one piece of advice
Okay,
be?
it's funny when I got the material to prepare for this. You said, "What about my students and what have I learned
Yeah.
from them?" And I've learned that there is an absolutely irresistible temptation that you have to avoid. So I try and get my students in the Ben Graham spirit to measure what are they getting when they buy this. What they all want to do is outguess the future. They want to do a short-term forecast that's better than everybody else. So 6 months to a year from now, they'll be proved right and they can dance. Well, to be on the right side of the trade in that environment, you really do have to be close to the companies and an industry expert. I would say do not do that. Resist the temptation to guess the future. That's what Ben Graham would have called speculation. Look at the value of what you're buying. And if you're doing these guys have got a great jet engine. Well, they've had a great jet engine for years, and they're experts in jet engines who know what the competition looks like in a way that you probably don't, unless you're the jet expert, jet engine expert.
Right.
That's the one piece of advice I give people.
It's great.
Don't give into that temptation.
That's excellent.
Value.
Yeah.
Not
I love
change
it.
in value.
I love it. I love it. Well, Professor Greenwald, thank you so much for coming on the Motley Fool Conversations. Obviously invaluable, kind of taking 45 minutes of your time. We really appreciate it.
For you guys, it's always a pleasure.